Alright, so this is our second Project 3 tutorial. At the beginning of the last one, I lied. I told you that we were probably only going to have one, but as it turns out, we need two. So we've done the income statement. If it helps you or makes you feel better, you can format these as dollars with no decimal points. And even if it doesn't make you feel better, at least have no decimal points. That will make me feel a lot better when I go to grade these. It'll be a lot less for my mind to focus on. Those decimal points just add clutter. All right, so moving on to the balance sheet. I'm going to have to scroll up and down. Bear with me. Cash and cash equivalents, those are my plugs. If you have more than one type of cash and cash equivalent, you'll forecast the total, then break down your subcategories based on the percentage of cash and cash equivalents that they are. So let's start with receivables. 6.97% of total revenue. Boom. Computer's thinking. Inventory, 9.73% of total revenue. Other current assets, 3.98% of total revenue. Total current assets. Remember here that we are going to add up only operational current assets as outlined in Chapter 7. We want to separate financing and operating current assets. So I'm going to come over here and I'm going to say total operational current assets, right? We need those to be separate. The sum total of all those. Gross plant, property, and equipment. Well, we're not really sure what that's going to be, but we are going to know what accumulated depreciation is. It's going to be last year's balance plus whatever we add for depreciation and amortization this year. And then if we forecast net plant, property, and equipment as a percentage of sales or total revenue, we can work backwards because gross plant, property, and equipment is going to be our book value, right, that net value, plus whatever accumulated depreciation is. So what this tells us is that Hershey's paid $4.1 million for these assets. They've depreciated $2.2 million, meaning that the book value is $1.971 million of their total, or that's the book value of their net property, plant, and equipment. Intangible assets, 11.5% of sales, and other assets, just a little over 3% of sales. Total revenue. I'm sorry that I keep saying sales, but that's because Hershey's only has sales. If you have other, know that I mean total revenue. It didn't like that. B46T, B46 Command T. All right, there we go. So our total assets are going to be equal to total operational current assets, net plant, property, and equipment, intangibles, and others, right? Don't include gross and accumulated depreciation here because then you'll just be double counting. And we will also need to add to this our cash, cash equivalents, and short-term investments, right? And that line is empty now. But by summing up all these categories of things, it's going to allow our plug to work later. We got it. Here we go. Accounts payable and accrued expenses is a subtotal, but accounts payable is 6.54% of 7.7 million. Accrued expenses is 10.5% of 7.7 million, which means that accounts payable and accrued expenses is the sum total of these two items. Current debt, we're going to forecast that as a percentage of total revenue. And then our total current liabilities, accounts payable and accrued expenses, plus current debt, right? Don't double count those two again. Accounts payable and accrued expenses. We only want to know the subtotal. Our long-term debts and leases, right? It's our backup plug if cash doesn't work, but we're going to start by forecasting it as a percentage of total revenue. Pension obligations, we're going to forecast those as a percentage of total revenue. Other liabilities, also a percentage of total revenue. That leaves us only with our total liabilities line, and in this case we're going to have total current, long-term debt, pensions, other, right? That's our debt, 4 million in debt. Then we need to deal with shareholders' equity, right? The portion of the assets that the owners of the firm have title to, or sort of. Common share capital, I'm just going to reference the year before and give it an absolute reference. If you have a different pattern showing up in your common size, follow that pattern. Additional paid-in capital appears to be growing at a different rate than sales, so it's going to get forecasted as a growth rate. And retained earnings is equal to the previous balance plus this year's addition, right? So we added to retained earnings this net income. Half of it gets paid to shareholders, half of it gets put back into the company in the form of retained earnings, which is used to grow the firm, buy new assets, whatever. And then our other accumulated comprehensive income is a percentage of revenue. So this one is negative, right, because this could be positive or negative. One item that's negative that is assumed that we're going to know that it's negative is treasury stock. Treasury stock is growing, right, I gave myself that different color so I could remember, at about 4.9% per year. And this is a contra equity account, so it subtracts from our total value of equity. So our common share capital plus additional paid-in capital plus retained earnings plus accumulated comprehensive income, because it's listed as a negative number, minus treasury stock. That's our total equity. So our total liabilities in equity is shareholders' equity plus total liabilities, 6 million. The only thing that we have left to do is figure out what value of cash goes here such that assets equal liabilities and equity, right? This balance sheet has to balance. Well, the way we can do that is that with the plug method. Total liabilities and equity minus all categories of assets that aren't cash. So we can subtract the operational current assets, we can subtract net plant, property, and equipment, we can subtract intangibles, and we can subtract other. And if we enter that formula, these two things should balance. I'm then going to go backwards and calculate my cash and equivalents line. And if you had some proportion of that was short-term investments and some portion that was cash and equivalents, you would have to divvy that dollar amount up between the two of them. This is where I cross my fingers. The reason I have to cross my fingers is because I may have made a mistake somewhere. And if I made a mistake somewhere, I'm going to have to then figure out how to fix it. Dollar signs or hashtags, not a bad thing necessarily. Oh, have you saved your file lately? And let's double check that we have balancing all the way across. I am hungry. You just heard my stomach growl because I don't eat anymore while recording tutorials. I get hungry. All right, so this, I think, looks good. At this point, I like to go through and add a few lines, right? I'm going to add a line for total revenue. I'm going to add a line above gross profit. I'm going to add a line above operating income. I'm going to add a line up above earnings before tax. Right, those are all my subtotals. And then for net income, I'm going to do the top and double bottom border, or top and thick bottom border, I don't care what, just some way to make it obvious. Then I'm going to come down here and I'm going to give myself a line at cash and short equivalents and short-term investments, at total operational current assets. I'll give myself one at net plant property and equipment. I'm going to give myself one at, what do we have, total current liabilities. I'm going to give myself one, that's actually going to be it. Nope, other total liabilities. And then here at total assets and total liabilities and equity, pardon me, I'm going to do the top and double bottom. Then it just looks a little bit easier, or a little bit more clear. It becomes more obvious what's going on. Instead of looking like a long list of numbers, it can draw your eye to important totals and subtotals. All right, that looks good. I'm going to call that good. I'm also going to call it good because it was the same answers I got when I did it in another sheet beforehand, so I've double checked. If you want to know if you made a mistake, right, because there's no answer key, how do I grade these? I go through and I check things like total revenue. Right? Is that a line? Is that the total? Yep, it is. And then I just go through these kind of one by one to make sure that they are what they're supposed to be. Right? I especially check things like depreciation and amortization, which need to be a value driver multiplied by an average. Just like interest paid on debt, which needs to be a value driver multiplied by the averages of two columns. Or interest income, right, which is another one based on an average. I also like to look at retained earnings to make sure that it's the previous balance plus this year's addition. And similarly, I like to check out gross plant, property, and equipment to make sure that these three things are handled correctly. Accumulated depreciation is the previous year's balance plus this year's addition. Right? I'll also check to make sure the balance sheet balances. You get the idea. So one thing you can do in order to check your work is to copy these rows over and later tonight or tomorrow morning run your forecast again and see if you get the same answers, right? Because you might have to be your answer key. All right, so that's it for now. Let me know if you have any questions. Happy calculating. I'm hoping you're feeling pretty successful. Talk to you later.